We are here on Real Estate in the Lowcountry. Goosehead Insurance is in the building. Today it is Kate Thompson. Good to see you.
Good to see you too.
Yeah, so I've talked a little bit about this before, but it's been quite a while, and now there's something new that kind of is becoming more and more a thing. That's golf carts. And so what we're going to talk about today is things that you may have lumped into your homeowner's policy that you may not want to have lumped into your homeowner's policy.
Yes, and I would view it as more of like a collections kind of conversation.
Yeah.
So we've got a lot of people who have high value items, whether it's jewelry or art, musical instruments, depending on what we've got.
Yeah.
We've seen
I
a
didn't
lot
even
of
think
things.
about musical instruments, but they're pretty penny. Yeah.
Yeah, some of them. I was about to say, and there's a lot of collector's items too,
Right.
baseball card collections we've seen a lot of, or like very unique collectibles. Those are things that we would want to make sure that we discuss to make sure we're insuring properly anyway. But sometimes it's worth it, in most situations it's worth it to move it off of the homeowner's policy to make sure that if something happens to those items, whether they're lost, damaged, or stolen, that you have that claim separate from your homeowner's policy.
And why is that important?
So we can help keep your premiums down.
Which is a great thing. We all want to keep our premiums down.
Please, let's do it.
Yeah.
And the golf carts we're just seeing tons of them. But the thing that we're seeing a lot of right now is we're going from golf carts to low speed vehicles.
Right, because they're not just in communities anymore. They're out there on the streets.
Oh yeah, they're out on the streets and they're going like 30 miles an hour.
Right, exactly.
So the rule of thumb is if it goes less than 20, golf cart. If it goes over 20, low speed vehicle.
Okay.
But that's different from carrier to carrier, but that's the general rule of thumb.
Okay. Even though it looks like a golf cart.
It can still be a golf cart.
Right, but it's not really.
It's not really a golf cart. It's a low speed vehicle. But those things are right now, a lot of people are just adding them to their homeowner's policy that I have seen, which if something happens, and heaven forbid you get in an accident, and you get sued, that's held up as a liability claim on your homeowners.
And so then that follows your homeowner's policy from forever then.
Oh yeah. Well, I was about to say not forever, but for the foreseeable future. To shop your homeowner's policy.
Right, right.
Absolutely.
And so obviously if it was on a separate policy, that would just be taken care of on that policy and your homeowner's is none the wiser.
I was about to say, you can still see if you've had like a claim, but on your homeowner's policy, if you make it on your homeowner's policy, it is definitely more severe.
Definitely worse.
Yeah.
And so that would be a reason that your premiums could go up. And they've gone, as we've talked about so many times, they've already gone up. So we don't want them to go up any further.
We're trying to avoid all increases possible.
Exactly, exactly. And so we are here at the end of the year, which is kind of crazy.
I know.
Through hurricane season, thankfully.
Yeah.
Done with that for a few months anyway.
Yeah.
What are you seeing, do you think, going into 2025? What are we going to look for renewals? What does the market look like here? Are we still in a hard market?
A hard market is starting to wane. Like we're starting to see carriers that didn't really have appetite for our location before, starting to dip their toe into the water and say, hey, like if we brought this kind of product, would you be interested? Or we'll open up this underwriting thing that may not have been open before. And so there's a little crack in the door.
Yeah.
And it's gonna, I believe, start to continue to eke its way open as time goes on.
Yeah.
After we see the renewal rates of reinsurance in January, where it's January and July are the two biggest renewal dates. Okay. So after January 1 and throughout the rest of that month, I think we'll start to see some more progressive entering, which will then create more competition and decrease our problems.
But let's talk a little bit too about renewals, because if you know that you're coming up on your renewal in a couple of months or when is the time to really start looking at it to see if we want to make any changes, to see if we need to add anything, to see if we need to take anything off, get a special rider like you were talking about.
Right.
How long does that process take? How long should we give ourselves for that process?
To give, especially if you've got a mortgage, 45 to 30 days before the renewal of that policy would be best, so we can give ourselves enough time, depending on the complication of your portfolio, like how much we got going on.
Yeah.
It can take a few days, right? So with those advance calls, it's just so much easier to change everything, and then we don't have to worry about whether something's going to get paid or not by the bank. That's the tricky part, because the bank's got to pay the bill, but they can't pay a bill they don't have. So we have to get it to them.
You do have to get it to them. But I think it's kind of important to know that you do need that time frame, because sometimes it comes up pretty quickly and you go, and panic. So give yourself that time.
Yes.
Kate, always good to see you. Thank you for talking to us about all these very important things. As usual, it gives us all lots to think about.
Thank you.